No major surprises from the Reserve Bank in its first monetary policy for the new financial year. The key policy rate expectedly, which of course is the repo rate, the rate at which the Reserve Bank borrows money from commercial banks, has been left unchanged as per street consensus. Governor Urjit Patel said that the inflation could accelerate and pointed at the uncertainty over monsoons, the one-time hit due to the goods and services tax as potential upside risk. Now, banks are flush with cash after demonetization, and in a bid to help them earn more money on those deposits and drain excess liquidity, the reverse repo rate has now been raised to 6%. We now have just a 25 basis point gap between the repo and the reverse repo rate. The Reserve Bank has said that they are waiting to hear from the government on the standing deposit facility. This, the central bank said, is its preferred option to suck out excess liquidity. Deputy Governor Viral Acharya also said the Reserve Bank will employ the entire toolkit at its disposal to manage liquidity. Now, in a bid to boost real estate and the infrastructure investment trusts, the RBI has made a crucial amendment. Banks can now invest up to 20% of their net-owned funds in REITs and InvITs. The final guidelines on this will be released by the end of May. So those are just some of the highlights of the monetary policy. Here's the Reserve Bank Governor on the inflation risks and more.
The MPC saw the path of inflation in 2017-18 as challenged by upside risks and unfavorable base effects towards the second half of the year. Accordingly, inflation developments have to be closely and continuously monitored, with food price pressures kept in check so that inflation expectations can be re-anchored.
Well, from inflation now to bad loans, and that continues to be the biggest headache for the Reserve Bank of India and, of course, the government. After holding a series of meetings with the government over the last few months, the Reserve Bank Governor today revealing that a variety of things will be put in place to try and tackle the issue. He also believes that one instrument cannot resolve the problem, and also hinted that existing systems for resolution will be reviewed if necessary. The governor also said the current pace of resolution is not tenable and that issues must be tackled on a firm footing. So this gives weight to the CNBC TV 18 exclusive news break that we've been tracking for the last 2 weeks, where the finance minister very categorically stated that the NPA issue was being addressed on a war footing in consultation with the Reserve Bank of India, and that the government and the RBI would do whatever is necessary to try and resolve the crisis. Listen in.
A revised PCA framework will be put in public domain mid-April, which will trigger actions by the RBI vis-a-vis specific banks going forward. The IBC is now in place. The RBI's enforcement department has started its work. And the fact of the matter is that there seems to be a renewed commitment from all sides, including the government, that we now need to address this in even a more forceful manner than we have in the past.
And it wasn't just the NPA issue. The governor also came down hard on farm loan waivers, terming them as moral hazards. He went on to say that loan waivers distort credit discipline, adds more burden on the taxpayer, and also throws the government's fiscal math out of whack. Here's what he said.
I think it undermines an honest credit culture. It impacts credit discipline. It blunts incentives for future borrowers to repay. In other words, waivers engender moral hazard. It also entails, at the end of the day, transfer from taxpayers to borrowers. If, on account of this, overall government borrowing goes up, yields on government bonds also are impacted. Thereafter, it can also lead to the crowding out of private borrowers, as higher government borrowing can lead to an increasing cost of borrowing for others. I think we need to create a consensus such that loan waiver promises are eschewed. Otherwise, sub-sovereign fiscal challenges in this context could eventually affect the national balance sheet.
Okay, let's take this further. Lata Venkatesh joins in now with her take on RBI's monetary policy today. Lata, what do you make of this, and what do you think are the key highlights?
Well, the key takeaway from the Reserve Bank is that, first of all, there need be no anxiety that liquidity will be pulled out through a CRR hike. So that's the big relief for the bond markets. The other relief for banks is that now whatever idle cash they have, which nobody is borrowing, they used to give it to Reserve Bank in the reverse repo window at 5.75%. Now they will get 6% for that money. That will be a positive. Of course, in the process, some of the yields have gone up, which means treasury bill prices have come down. So there are immediate losses. But net, I think on the longer term, banks stand to gain. And the narrowing of the corridor is always good practices internationally. Therefore, a positive. A third positive really is that banks now can invest in real estate investment trusts and in InvITs. That is this infrastructure investment trust. That would be good for both these highly beleaguered sectors. So these are the positives. The cautions, not really negatives, but the cautions for the market is that the Reserve Bank has slightly upped its forecast for inflation for next year. It was at 4 to 4.5 for the first half. Now they made it 4.5. For the second half, it was 4.5 to 5. Now for the current year, the year-end target is actually 5% second half. Now, if even there is a slight upside risk to it, it's quite possible that at some distant date, within 2017 itself, there could be a rate hike, and that's why you saw bond yields jumping up. Clearly, slight hawkishness in the Reserve Bank's view of inflation. But, things need not pan out, and even if inflation reached 5, I don't think the Reserve Bank will be in a hurry to hike rates. They will wait for probably inflation to transcend 5 before they hike. And any such rise in inflation will come only if there is substantial improvement in demand. So it's not a very big worry, but it's good to keep that caution on your mind. Don't expect any further falls in your EMIs or falls in your car rates or home loan rates. Whatever has to fall, the fall has come. Now, if anything, there may be a minor fall in your FD rates. So the good times for consumers is over. If you want to book a home or a car, you can start right away.
All right, Lata, thanks very much. That's a wrap and a summary of the credit policy, the monetary policy that was announced today.